So today we're going to talk about 5 things to buy during a recession. I'm here in Ukraine right now on a humanitarian mission. I've paused with a little bit of a lull to make this video. And I'm going to tell you right now, being in a war-torn country and delivering this aid and the medical supplies and the body armor and the things that we're doing, it can't help but get me thinking just a little bit, wow, what would happen if America experienced this? What would happen if this becomes more of a world war? What happens when the world turns a little bit more in this direction? And you know what? Consumer confidence is down. People are panicking. People are scared. And you know what? When confidence goes down, the markets crash. And I think we all know that we're due for a crash. Some of us are thinking, maybe, Kris, that's already started. Look at the last month, what's happened in the stock market. And so it's important for you to know, what should you be investing in when the market does crash and we go into a recession? Let's talk about it.
One shot, not a future for sure. Let's go. I'm turning dreams into reality. Yeah, it's one shot, not a future for sure. Let's go.
I'm still a pretty young guy, but you know what? I've now been around the block a few times, and the last time was 2009. We experienced the Great Recession. And how bad was that? Well, I'll tell you first that the years leading up to 2008 October, when that recession hit, it was money. You couldn't not make money in real estate. You couldn't not make money in the market. And when that recession hit, it's almost the worst that we've seen since the Great Depression. The Great Recession is considered the most significant downturn since the Great Depression. Unemployment peaked at 10% in October 2009. Home prices fell approximately 30% from their mid-2006 peak, and the S&P 500 index fell 57% from its October 2007 peak. So think about this for just a moment. You've got real estate crashing hardcore 30%. You've got the stock market almost plunging by double, 57% since its peak. And you need to understand that a downturn does not always mean that real estate and the stock market will go down at the same time. It happens 2/5 of the time, or 2 out of every 5 recessions. So 2009 was definitely one of them. What we're going into right now is definitely different than that, because real estate is peaking and on the rise, and the stock market is doing its downturn right now. So in this video, I'm going to share with you Investopedia's top 5 things that they think you should invest in. I agree with some of them. There's others I don't agree with, but I'm going to share with you their top 5 anyway, because it follows a lot of common popular thought that's out there. I'll tell you though, first, when the recession hit, I remember exactly where I was sitting. I was about to sign on this house with like a 6% interest rate, and the bank on the day of closing said, just kidding, we've raised the rate to 16%. Which was their way of saying, you're not going to close on this loan if last minute we adjust the rate, which is our right, up 10 points. That bank folded less than a month later. And as the market was crashing, it was kind of interesting to me, because there's a lot of people that were, listen, they were like ostriches. They put their head in the sand. They were waving the meaty part out for the tiger to basically take them out. And the tiger did. They kept their money in the stock market, and they got pummeled hardcore. People got slammed hardcore in real estate because the market had been going up and up and up. And you know what? The higher the market goes, people play this game. They're like, well, if you buy a $200,000 house and the market goes up 100 grand, you make 100 grand. But if you buy $1 million house and it goes up to $2 million, then you become like an instant millionaire in equity. Yeah, but those higher price homes are the hardest to fall. So there was this initial massive readjustment, and the real estate really hurt people who had overpriced housing that they couldn't rent out, they couldn't sell, and they couldn't make money on. But I did something different that allowed me to help my investors make over $100 million over the 5 following years during that recession. And at the end of this video, I'll show you exactly what we did, because we're doing something very similar right now. Now, as the economy appears to be headed into another downturn, it's a good time to review how to take advantage of the recession instead of sitting by idle as your portfolio gets pummeled by massive selling. And Investopedia, that a lot of people go to for financial advice, basically says, hey, during a recession, there's 5 specific things that you should be doing. And I'm going to share them with you. The first one is called dollar cost averaging. It says, number 1, use the dollar cost average when share prices decline. When the market starts to plunge, it's time to take advantage by increasing your contribution in a non-qualified investment account. And by the way, a non-qualified investment account means anything that isn't like a 401k or an IRA. Non-qualified means you got paid from the money that you earned, you paid taxes on it, and now you're gonna put it into like antiques or art, or you could put it into your savings account, or you could, go and buy something. You could literally go and buy stocks. And here's the idea of dollar cost price averaging. As the share prices drop in whatever it is that you're buying, your contribution buys an increasing number of shares and your cost basis continues to drop. When share prices rebound, your contribution buys fewer shares each month, but the current share price is always higher than your cost basis. In other words, like think in terms of crypto, right? Like crypto, when it goes down, that's when the real investor buys, and they're using dollar cost price averaging. They're basically saying, hey, things have plummeted in price. It's on sale, pick it up. So when the market rebounds, you're gonna have even more shares than you would have originally started with. Said in the simplest way possible, buy things on discount. Now, do I agree with this? 100% yes. You should always look at buying an asset at its best timing, because that's what's gonna help aid in the best performance. The second piece of advice that we get here from Investopedia is to buy into dividends. If you're going to hold stocks during a recessionary period, the best ones to own are large cap companies with strong balance sheets and cash flows. Not only are these companies better situated to weather economic downturns, but they're also more likely to pay dividends. Dividends provide a return cushion during tough economic times. Think about it this way. Like if the market drops 30%, and let's just say that Apple stock, a company you and I know, or we're talking about Jeff Bezos' company, Amazon. If a large company like that drops 30%, do you really think that Amazon is now worth 30% less? Of course it's not. That doesn't make any sense. What that is the market is responding to a lack of consumer confidence, which is why always after every major downturn, it never takes, historically speaking, longer than 36 months for the economy to bounce back, which means that would actually be a great time to buy Amazon stock. I'm not recommending their company, but other large cap. Why? Because you know that their intrinsic value hasn't gone down. Once the market rebounds, it's like basically saying, oh yeah, I picked up Amazon at a 30% discount, or people that were buying from the peak from 2006 who had a 57% downturn, they're too busy licking their wounds saying, I got hurt by the market. But that's actually the time to deploy cash. In other words, you should never have all your capital deployed as you start aggregating more and more and more of it. Because when the market goes down and everyone is selling, that price plummeting as people selling, confidence is low, that is actually when you go in to buy. You do that for crypto, you do that for the stock market. So I agree with that sentiment and portion, but here's what I disagree with. The idea of using stocks as ability to gain wealth, I'd say it's more of an intelligent holding spot, especially on a rebound. I don't think it's gonna make you rich, especially if you just focus on large cap, because these are companies that have already had their moonshot. They've already gone through the roof. They're now stabilizers in the economy. Think of a blue chip company or one of the top 500. That's what the S&P 500 means, the top 500 companies. These are your largest, most stable companies. Do you really think they're gonna go through the roof again? No, they already have this, like this huge hockey stick growth curve. And now they're plateauing out, and they're probably going to experience, for the most part, some good growth, but likely single digits. You're not going to get rich. So for me personally, when a recession hits, I look to build and grow wealth. I don't look to play it safe. So that's the part that I disagree more with. Number 3 is a little bit fun for me to share with you. It's about purchasing precious metals. The claim is that in a recessionary downturn, you should buy gold and silver. And if you've ever heard that, maybe you're wondering why. Precious metals like gold or silver tend to perform well during market downturns. But since the demand for these kinds of commodities often increase during recessions, their prices usually go up a little bit as well. So think about it this way. It's like, okay, things are decreasing in value and my goal is just to like hold still, or you know what, maybe even go up a little bit. And they're basically saying that's what gold and silver is good for. And I'm going to tell you that a few years back, I paid hundreds of thousands of dollars to join Tony Robbins' mastermind, but at the highest level possible. I was a lion in this group. And I sat at Tony's house in Florida during this special conference with like 44 other people in the room. And one of my buddies, Bill, basically just said, hey, with what's happening in the economy, gold, 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 gold. And Tony Robbins reamed the dude, my friend, and called him out for taking way too aggressive of an approach. And it kind of stuck with me a little bit. And I agreed with Tony because I think that gold and silver is what you either buy when you're a prepper, like you're afraid that it's the end of the end, in which case I'm like, hey, do you really think that, in the end that people are going to go back on a gold standard and that gold will have value? I think alcohol will have value. I think commodities, I think food, I think supplies, I think guns will hold a lot more value than gold and silver, me personally. So you're either doing it because you're a prepper or you're doing it because you're using it as a hedge against the downturn. And I'm going to tell you right now, while it's good advice for the financially illiterate, if you're a subscriber on my channel and you're learning how to make money, your goal shouldn't be to have your money just holding even Steven. You should be instead asking this question: what is the biggest problem this particular recession is creating? Because the bigger the problem, the bigger the solution. And if you get in on the solution, you're not having your money working for you holding even. You've got an opportunity to participate in moonshots or things where there's tremendous growth. When there are really big problems, you got to be keeping your eyes out. When everyone's running in this direction, be counter-cyclical. Run in the opposite direction because that's where opportunity lies. Gold is a little bit like saying, I'm burying my money. I'm burying it in the ground and I'm going to try to keep it as safe as possible. Investopedia's fourth piece of advice is to invest in consumer staples, but maybe a little bit different than you're thinking. Even during recessions, consumers need to buy food, hygiene products, and medical supplies. These are consumer staples that are the last items to be cut from the family budget. Because of this, consumer staple companies are sometimes called defensive stocks, since they tend to remain resilient even when the economy falters. Again, there's a little bit more of a stock play saying, hey, if you want your money to hold even, maybe even go up, then invest in the items that people need the most. Who are the Ciscos, the companies that are out there that provide these basic necessities? Because in a recession, those companies probably are going to do pretty well because people aren't going to cut those from the budget. And you know what? I agree. Again, I don't think it's an aggressive wealth creation strategy. I think it's a little bit more of a playing it safe strategy. So take that advice for what it's worth. I'm all about building wealth, not just trying to stay even. Now check it out. The fifth piece of advice is definitely something that I massively agree with. Remember when I told you earlier that when the Great Recession hit 2008, that I went heavy in the game of real estate, even though there's a lot of people that got hurt by high-end real estate, myself included, right? I mean, I owned a multi-million-dollar house that I was living in and the value dropped in half. And there was even for part of that recession when I was considering selling the home and I couldn't even sell it. So I'm just gonna tell you right now, like I know what that feels like. But during that exact same period of time, I went into Las Vegas and Phoenix, 2 markets, even Florida, 3 markets that had built the most explosively in the years prior. And so when the market reset, they got hammered and brand new real estate went back to the bank, and homes that had been selling for $300,000 or $400,000, I was now buying for $100,000, $140,000. And you know what? I knew what would happen in the next 5 years. We ran out of real estate. No one built for 5 years. When the market came back after renting those for a few years, it was time to sell them. And we had gained over $100 million in appreciation. And you know what my biggest regret was? That I hadn't bought more, which is why right now in this recession, guess what I'm doing? Consider buying real estate. The 2008 housing market collapse was a nightmare for homeowners. However, it turned out to be a boon for some real estate investors. When a recession hits and home values drop, it may be a buying opportunity for investment properties. If you can rent out a property to a reliable tenant, you'll have a steady stream of income while you ride out the recession. Once real estate values start to rise again, you can sell them at a profit. And that's textbook exactly what I did. And that's exactly what I'm doing right now. Now, if you're a subscriber on my channel, you've heard me talk about this before. And here's my invitation. Right now is the time to be buying real estate. Right now, the more real estate you own, the better it's going to be for you. If you can own 2 homes right now, buy 2 homes, because there's a good chance in 3 or 4 years, you can turn them into 5, 6, or 7 homes. If you can buy 5 homes right now, there's a good chance you can turn them into 10, 15, or 25 properties. And I'm going to tell you right now, imagine making $50,000 to $100,000 on every house. In the beginning, how I became wealthy was buy 25 homes, make $100,000 on each one of them, make a couple $1 million, have a 6-figure residual income, quit your job, have the money, have the time freedom, live the life that you're supposed to. That is the message right now out of all the advice that makes the most sense to me, because I've done it before. Check it out. If you've ever wanted to get in the game of real estate investing, but maybe were nervous, didn't know how to find a good deal, didn't know where you were supposed to buy it, maybe you've been watching my channel and you're like, Kris, I don't think I ideally live in the right part of the world for making the most money or the easiest money in real estate. Or maybe you're just thinking, Kris, I'd rather just have a partner that's experienced, that's done 6,000 homes and is willing to be generous with me. Well, I call that a partnership. And that partnering is where we become 50-50 partners. If you have any money at all sitting in a 401k, IRA, the stock market, and you want to transition into real estate, first of all, that's one of the smartest things that you can do for the next decade. And so if that speaks to you, there's a link below. Click it and it'll give you an opportunity to read up a little bit more on partnering with me. If it resonates, talk to a member of my team. If we partner, you're going to have my cell phone. We're going to be personally connecting. We're going to be building a multi-million-dollar portfolio. I can get us there even if we can just start with a single property. So if that resonates with you, click the link and I'll see you on the flip side. Well, check it out. I've got to get back to my humanitarian mission, and we got a lot of good to do while we're here in Ukraine. I want to thank you for watching today's video. Give this video a thumbs up if you liked it. More importantly, if you want to continue your journey and you really want to understand my predictions on when I think the market's going to crash, I teamed up with a mentor of mine, Dolph DeRoos, and we laid out 7 predictions and basically talk about what we believe is going to happen in the year 2022 and the years after. If you want to see what that looks like, click the video right here, and I'm going to get back to it. See ya.